Hi, Abhishek and Vinay. Welcome to this call today. It's a pleasure having you here. And I think it's a great time when we are doing this call. Markets on a roller coaster ride. And of course, we guys are now the third largest market from market valuation perspective as well. And there's a lot seems to be happening in the market. And great time that you're launching a new fund, your PGIM large and mid cap NFO. And of course, the entire euphoric ride on the markets, plus the entire sentiments are hugely positive. We can see with the kind of flows coming into the equities, whether
Yeah.
we SIPs or the SIP AUM, the SIP collections, or the overall equity gross and net sales as well. But of course, clients are redeeming their money at the same point of time because some do believe that it's time to good kind of profits as well. So I think it's a great time catching up with the two of you, and thank you so much once again for joining in. First of all, congratulations on achieving the threshold of 10,000 crores of your mid cap fund. I think it's a great achievement. Maybe Abhishek, you could just let our viewers know in terms of what led to this success.
Yes, lovely, Suryan. First of all, thank you for having us. It's exciting times as you have plotted already. I think you have given a lot of data points already. But I think exciting times with polarizing times as well. And I think a lot of what we will cover today in this presentation, while Vinay talks about it, and I leave the tough talking to be done by the person who does that, who does manage that show. But just to give you a context, I think, and the point that you have brought out, I think 10,000 crore on mid caps. If I was to go back in history and ask my entire team, I don't think we would have looked at that number in 2023 as a reality. Just to give you a context, we started in 2019 regrouping, and at that point of time, the assets under management for the mid-cap fund was 120 crores. Uh, just to build on that, and I think what worked for us is essentially first the process, and I think you will hear a lot of process today as well. But just to connect the dots, I think in 2018 and 19, when we were on the road starting to build up our business, it was all process. Performance to baad mein aaya. Performance came later. And the good thing is that performance, the theory, the story, all of that added up, and people could literally attribute all parts of it in coming into that performance, which is what built up the confidence. The good news is that when we think of it from a sustainability perspective, on an average in our best times, we were clocking in about 7.5 to 8,000 unique ARNs who were supporting us. And I must say a large part of that was supporting us in the mid cap fund and the flexi cap fund, but primarily the mid cap fund. Also, the good news is that from a small 4.5 crore SIP book, our SIP books had gone to a 275, 280 crore. I'm
Mhm.
talking about money in the bank SIP, not not just the registered SIP, which is a very different number for the industry as well. But when you put all of that into context, a large part of that, maybe about 35 to 40% of that is also in the mid cap fund. So you can clearly imagine that I think what has worked for it is the broad-based recognition of the process, the themes that we have run. We have kept to the process, and I think that has translated into performance. And there's nothing better than that.
Fantastic. No, I wish you the very best for its growth momentum to continue. So the other thing is that we almost have 27 large and mid cap, funds running uh, in the industry today. And from April of 23, the AUM has moved from 1.33 lakh crore to almost 1.87 lakh crore as we speak on December of 23. So just a thought that why did you think of launching, the large and mid cap fund now? When actually, from the overall industry AUM perspective, if you look at the AUM has actually shrunk from 8%. I mean, the percentage of this category
Right.
to the overall to 4%.
Right.
And if you were to actually further dissect, though the gross sales as the net sales have been ranging in the range of about anything more like a 9 to 10 odd percent from the perspective of the gross sales, and the net sales have been more in the range of 7 to 12%. So what were your thoughts in terms of launching this fund now? And
Yeah.
how do you believe that from a risk return and diversification perspective, this fund actually fits in very well?
Great question, Suren, and I think a very, very important one in the current parlance. And rather than diving straight to the reason for launching the fund, I'll just maybe I made a comment earlier that polarizing times, polarizing markets. I think a large part of last year, and this is very much a data in the public domain, hence I can quote it. There was a point where about 55% of the incremental gross sale was starting to happen in just one category, which is small cap. The point that I'm bringing out is that there's nothing wrong with people participating in small cap because that is the faster growing category
Yeah.
from all perspectives. But then let's realize the kind of the nature of clients who are participating. There are even first time investors, people who are opening up their first folios, jumping into it just for the attractiveness of the returns that they can see on the charts. When we thought, and let me just jump into it, when we thought of getting into this category at this point of time, first and the foremost, I think to be very, very honest, we want to complete our basket. There's no hiding that fact. And I think a large and mid cap fund, while in the recent past may have lost some ground on a relative basis, and some part of that can be understood by what is happening in the small cap. And I think they are eating up share for all other categories in the recent past. But the fact is that if you were to look at from the inception of this category, which dates back to recategorization, this category has grown at 34% CAGR. If we were to look at the entire mutual fund industry assets, they are growing at about 19% CAGR for the same time frame. So clearly, the category has found acceptance. It's broad-based. Some attributes that we see in the category is that not only does it provide you stability and a very, very good opportunity for participating into growth sectors which are not present in the pure large caps. At the same time, when you look at your charts, and here I would actually lead people to use some of the analytics that Advisorkhoj provides freely. I think beautiful analytics. I was just looking at some of them. You would realize that on a 3-year rolling, and if we were to date back to the large and mid cap index itself and plot a Nifty 100, a Nifty large and mid cap, and a Nifty 500 representation set for large cap, for large mid cap, and practically for a flexi cap mandate, you would realize that on a 3-year rolling basis for this long period of time, the large and mid cap is the best performer.
Mm-hmm.
And the degree of outperformance is about 3% CAGR.
Mm-hmm.
Combine this with the fact that even in downturns, it has been able to protect downside better. And hence, when you will study the statistics on a risk-adjusted return basis, the returns are surely higher and risk is lower. The only category which in itself outperforms this category sustainably is a pure mid-cap category. And we all know, mid caps is, I mean, 100% mid cap exposure is right for a customer who can really take all in risk. So if you were to be looking at stability with a, an opportunity to create alpha, sustainable alpha, clearly the large and mid cap stands out.
Sure.
And
In
that's
fact,
exactly the reason why we are launching into it. There is also a sub reason, which I think I'll let Vinay talk about more in the subsequent part of this discussion. But let me highlight that while we are at a market high, there is a portion of market which has really outperformed every other portion. And I think from a market standpoint, that is the portion which has taken everybody by surprise. Uh,
absolutely.
Clearly, managers and investment processes which are linked to high quality and high growth are the kind of processes and portfolios which have taken a back seat in the last 18 to 24 months, and even for a little longer for that matter. But history proves that if somebody was to just close their eyes and look at long-term data cuts and just see a 3-year interval, which is the 3-year rolling period return that we always reference towards, you would realize that an strategy which is just buying high quality, high growth comes out as a winner 63% of the times. Now that's the probability that stacks up in your favor. In one of the discussions with an MFD group, we were joking, and on a very lighter note, I had to literally ask somebody to say that, if 63% doesn't satisfy you, then you shouldn't be praising Sachin Tendulkar. His average is lower than this. So, on that note, what we believe is that when the market rotates, when the market finds a semblance in the reality of high quality and high growth, this is the portfolio which will create a much, much better experience related to any other portfolios available in the market. And that hence we thought it is the right time, and we feel very confident about launching the product now.
No, that's very fair enough. I completely agree with your thought process. So I'll kind of jump a question here. And, you know, it certainly happens to be one category, large and mid cap, which should find a lot of attention in the market from
Yes.
any first time investor or even an existing investor. But somehow, as a category, it's not found so much of favor, even if you look at from the gross sales, net sales, or the overall AUM perspective. And very well put across by you. Of course, there has been a run on a more favor towards small cap, so to speak. So, what do you believe? And this question is for both of you. What do you believe have
Yeah.
the reasons been as to why this category, has not found so much of favor, and now, and of course, when it actually does deserve a lot of attention?
So maybe I'll
Uh,
start and I will hand it over to
yeah,
Vinay with that. And what I like to bring out, Suren, is exactly what I pointed at earlier. I think market catches the fancy towards absolute returns. And
Yeah.
I think last year or 18 months have clearly belonged to small cap. Uh, and also a part of the market, which Vinay will highlight, is the set of market which most people would not have believed will do as well as it has done. It was a cheaper part of the market. It was not really the quality part of the market, but it has done phenomenally well. And I think a large part of that has to be attributed to the fact that small caps as an index, when you look at the breakup of that index, a large part of those companies are sitting in that benchmark index as well.
Hmm.
What we should really understand is that when we look at the average experience, and I think, across when we are doing roadshows, when you ask this question to our distributor fraternity, there is a combined answer to say that give us an answer which can help us lengthen the horizon for a client. And that's another way of saying that tell us the story which will be the winner so that we can keep the clients into the equity markets for longer.
Yeah.
Now, if you look at both the things together, you will realize that the last 18 months have belonged to small caps, and hence everything else has lost because the degree of outperformance itself is so large.
Yeah.
But let's again go back to rolling performance for these indexes again. And what you will realize is that small cap by nature has always performed in small cycles, but whenever it performs, it shoots the light out of the roof, and everything else looks very, very small. But on a rolling basis, all other indexes would give an average experience which is superior than a pure small cap index. And I think there will be times, and I don't think the year of 2023 is going to repeat itself again and again and again. If that does, then we'll have to revisit our thesis, I'm sure. But it doesn't look like that is a reality. But Vinay, please, over to you.
I think Abhishek, you have summed up most of the arguments very well. But just to reiterate that aspect, that we have followed a very clear strategy of investing in companies which are both good quality companies as defined by their prospective returns on equity, and which are high growth as defined by their growth in gross profits on a prospective 5-year basis. So we generally tend to avoid companies which are showing growth in profits due to temporary factors, which are cyclical and which will fizzle away over a short period of time. Our objective is to invest in companies which are much more structural in nature and buy and hold them as long as possible and create a diversified portfolio of such companies. And why did we adopt this approach? The answer is very straightforward. We have tried to do a back testing of this entire approach, going back up to as back as to 2003 to 5 period, and from there on, what we checked and understood and found out is that any investor who would have followed this approach on a rolling 3-year basis would have outperformed the general market by a material proportion and the probability of his win, as Abhishek highlighted, was about 63%. And more importantly, if you do not follow this strategy, but follow the strategy at the other end of the market, which is buying weaker quality companies and poor growth companies, you would have outperformed the market only 2 times out of the last 15-year rolling 3-year periods. And unfortunately, one of that two times is the period we are in. So I think the magnitude of outperformance of weaker quality and low growth companies, which we have seen in the last 3 years, is unprecedented. And that opens up a huge opportunity for an investor who's ready to look over the near-term underperformance. In fact, if you look at our fund's performance, they have been quite underwhelming. And the reason is that we are ready to sacrifice the short term for a very long-term outperformance, which is investing in these superior quality companies. And I think that is one of the big reasons why we remain so confident in launching an NFO and creating a portfolio out of companies which are, even in the current market environment, we think are trading at reasonable valuations.
Absolutely, absolutely. And I do believe that large and mid cap is a must-have portfolio in any valuation times in every client's portfolio. It deserves an allocation. So when you spoke about the entire process, you did touch upon it. So what would be typically your selection and a portfolio creation process? And if you could just also let us know a bit more about your entire quality, growth and the management process which you follow at PGIM.
Sure.
And the other question is that how many stocks do you probably plan to hold in a portfolio like the large and mid cap?
Sure. So I'll just briefly touch upon how we manage the overall investment process at the fund house. Then we can talk more about the fund. So the overall process is divided into two parts. First is on stock selection and second is portfolio construction. In terms of stock selection, what we do is we look at all companies which are more than 1,000 crores in market capitalization. And there are approximately 1,200 companies currently which are having, which satisfy this criteria. From these 1,200 companies, we then filter out companies which satisfy these twin criterias of high quality and good growth. So they should have a growth higher than the overall average, and they should have returns on equity higher than overall average on a prospective basis. After we select companies from which satisfy this twin criteria, we take them through a management quality checklist. So one of the parameters which we tend to look at for management quality is how many years the company has generated positive operating cash flows in the last 10 years. And our objective is to select companies which have had at least 70% of their times generated positive operating cash flows. That's one of the key parameters which we want to look at. We want to look at companies which have good capital allocation track record by the management which has maybe underpromised and over-delivered, and who does more and speaks less. So I think some of these criteria can be verified using historical track record, annual reports, etc., which is what we tend to extensively use to screen out quality of management. So after all of this, we have a list of companies which satisfies our criterion. Currently, we would be having approximately 180 companies which satisfy this criterion, out of which there would be approximately 120 companies in the large cap and mid cap space, which will find their position in this fund. And from these 120 companies, we intend to select approximately 60 to 75 companies to create a portfolio of well-diversified set of portfolios from these companies. And we think that portfolio should be reasonably well diversified across sectors also. But some of the key defining features of this portfolio is, while it will be diversified, the objective is to have higher than peer average active share. So I'm sure most of your viewers will be aware of active share. Active share is a measure of how different your portfolio is versus the benchmark. So while we may have a larger number of stocks, doesn't mean we will act and behave like the benchmark. In fact, maybe approximately 2/3 of the portfolio might be different than the benchmark. We will then also endeavor to have portfolio construction true to mandate, which means we would avoid taking any cash calls. We would avoid going down in other segments of the market, so on and so forth. I think that's how broadly we would be creating our portfolios.
Sure. Thank you so much. That brings me to my next question, Vinay, is that how do you believe the valuations currently are if you were to look at, the mid caps or the small caps, and specifically, there is a lot of stories going around about, the mid caps and the small caps being overvalued, etc., and large caps, of course, there is still a gap. So what are your thoughts around that?
Sure. So I think if I were to look at the overall market, clearly, as you rightly said, large caps are reasonably valued. They are trading at very close to their current fair values, and hence, broadly, on an overall basis, large caps are attractively priced. On an overall basis, small and mid caps are priced at a significant premium to their current fair values. However, there is a nuance here, and we think it's clearly a two-tiered market in the small and mid cap space. One segment of the small and mid cap segment of the market is actually trading at reasonable valuation, and it has significantly underperformed. And that segment is of companies which are good quality and high growth nature. And the companies which are in bubble zone are clearly companies which have had a patchy track record, which means these are low growth and poor quality companies. So I think clearly markets are in a bubble in poor quality, low growth segments of the market. We are clearly seeing signs of froth in the newly listed IPO companies, and that's an area we should be very careful of. We are seeing froth. In fact, we call them as micro bubbles in the public sector enterprise segment of the market. We are seeing bubble-like formation in industrial and capital goods segment of the market, specifically the railways and the defense segment. We think real estate as a segment is now enjoying bubble-like valuation, and SME segment of the market is clearly avoidable. So I think these are sort of micro bubbles which are brewing in the market. If as an investor we sidestep many of them, in fact all of them, we should be doing fine. We are in a high growth economy, and I think overall markets don't seem to be stretched, but definitely these segments of the markets are as I said, in micro bubble zone.
No, that certainly gives a lot of confidence to me as well, and plus the viewers as well. So what percentage would you recommend an investor to have ideally a large and mid cap allocated in its portfolio at any given point of time? And of course, Abhishek or Vinay, either of you could probably answer that. Let's say if I'm talking about Abhishek's portfolio. So,
Sure.
and I'm not talking about Abhishek now. I'm not talking about Abhishek starting to invest from his initial days and continuing to be. What percentage of portfolio allocation would you advise or suggest to an investor for the large and mid cap?
So you have made the job easy because you have put the context as an individual who I understand probably well enough.
No,
But
let
if
me
it
tell
was,
you, it happens to be one of my most
yeah,
favorite categories.
yeah, no, so absolutely, Suren. So I would be honest. I would possibly take one step further, and I would say that why only me? If we were to do a categorization, I would say for an investor who understand or who knows the kind of risks that he wants to take, for the core category, large and mid cap is the exact portfolio that he needs. For an investor who's coming first time into the market, doesn't know anything about it, but wants the manager to take that call of searching for the best category possible, FlexiCap is clearly a superior category. That is how I would look at it. If we were to look at allocations, obviously it will depend on, what are different goals that people have. But assuming if somebody is going with a portfolio which is high growth in nature, which means that practically he would be 90 to 100% equity at the beginning of it, I would say at any given point of time, possibly a 50% out of that should be sitting in a category like this.
Excellent. Brilliant. That's the number actually I was looking forward to listening from you. Yeah. With this, so much of changing dynamics on the distribution landscape, how well, Abhishek, your fund house is geared to, adopt to those changes? That's part one of the question.
Yeah.
Part two of the question is that, how many branches are we now across the country, and how are you, planning to expand your footprints? Are you looking at more digital, or like we were discussing, phygital way by opening up more branches as well? Something on your distribution strategy.
So I'll take the second part first, Suren, and it's an interesting one because we debate a lot, we do less in terms of opening up branches. But let me honestly tell you that while we are at this juncture, we are already 27 physical branches. We may not want to open too many, but the simpler strategy that we have taken is to make sure that we have at least one representation in each state. And then in pockets where we require more, physical handling and interference, we don't mind but open more branches, even if that means that it is just a sales outreach branch. Having said that, I think a large part of our focus lies on phygital. We have a whole virtual relationship manager channel. So if I was to, and I did point out a number at a point in time in this discussion, right at the beginning, I said about 7 to 7,500 unique ARNs were contributing to us. I must say that out of that, only 3 to 3,500 is who we actively service through my physical team. The rest of it is actually being serviced by my virtual relationship manager team, and that's been phenomenal. It's been a revelation for us, if I may say so. We're expanding that team. We are putting more resources on our distributor-initiated transaction platform. We are clearly putting more resources in terms of even introducing our partners to platform like yours and other platforms, which even help people do their transaction and reporting apart from analytics and things like that. I think if I was to bring all of that in, and if I was to talk about a few pillars of what we try to do, one, I think we would always be very, very conscious about adding value when we talk about a product and proposition. Keep the process first, returns as an outcome. We would always be very, very conscious that I think everybody who's running a business of their own knows better about the business. The only edge that we have is that we speak to so many people across the country. We could pick up potentially the best practices that we see and understand and help somebody adapt it. And there have been cases where very, very senior advisor friends have come back and told that, Abhishek, what you would have told me because you would have seen it somewhere else was a revelation for my team, and that's just helped us acquire so many new clients. To be very honest, it's not my original idea, but that just helps the case, and we make sure that we add that value in practices. So we clearly believe that adding value to the business practices, giving them perspectives, trying to contextualize and help people do those one or two incremental changes, which thankfully we get to know because of the huge network that we service, is the second most important pillar. The third one is we are continuously prodding people to use technology. In fact, we don't talk about it enough, and I see the need of why we should be. In our distributor-initiated transaction platform, there are many firsts. Like, for example, the top-up SIP came up first in our distributor-initiated transaction platform. It was not available in any platforms for that matter. Even the initiation of top-up SIP now across platforms is something that we as a fund house has been working with these platforms for the longest period of time, and we have been able to make it work. And so on and so forth. There are enough examples, enough initiatives that we take there. We try and do a lot of prodding, but as I said, I think a lot of that work is happening behind the scenes. we need to be started talking about a lot more of that.
Sure, sure, sure. No, thank you very much.
Yeah.
Vinay, question to you is that, if you could just let us also know in terms of, your investment team structure, how many people, etc., and, the overall structure basically. And plus, being a global fund house, are you more global to local or more local to local? How well are you integrated, in terms of your decision making or stock picking, or because I truly believe that any global fund does bring in the best risk management practices, back, because that's the place where, of course, a lot of superior technology comes in and the thought process comes in. Just your thoughts around that as well.
Sure. So first, um, in terms of our team structure, currently we are at a 10-member investment team, which includes me as the CIO. We have 3 fund managers, 4 analysts, and 2 dealers. So that's the current structure of the team, a reasonably good-sized team and well-distributed team. In terms of whether and how do we operate in terms of our global PGIM investment teams, I would say it is a local and global team,
Okay.
right? So we have best of both worlds. We actually interact with our global counterparts. For example, there is a monthly conference call with the CIOs of all PGIM universe across the globe, and we all share our thoughts relative to our countries, and we have an interaction with them on different types of investment challenges, investment potential, etc. For each of these economies, we get to understand the global trends which are happening in the markets. That's one. In fact, we do have access to a huge database of in-house research from PGIM global counterparts. I think Abhishek does share some of them from time to time. But while there are many such initiatives globally, we are also enjoying independence locally to have our own investment process, keep honing it, and practice what's great at the local level.
But that's brilliant, because I think a well-integrated system always helps in giving the best risk-adjusted performance as well. And today, of course, the world has become so small yet big in a way, that more information supply happens, more integration is there. Certainly, it helps, the investors here as well. Thank you
Yeah.
so much. So my next question to both of you is that through this, video, what message would you like to give? And Abhishek, I'm pointing my question first to you. To the mutual fund distributors as well as investors in the current market situation.
Perfect. So since the investment manager is going to be answering later, let me wear the sales hat, sales and the marketing hat, and answer that for you. I would say that one, there is clearly, and as Vinay highlighted during his part of the discussion, that there's clearly 2 parallels in the market operating, where one of the parallels, which is constituted of high growth and high quality, has clearly taken a back seat as far as capital market performance is concerned, whereas the actual earnings performance is much, much superior. It's only getting better and more broad-based. The second part of the market, which is performing today, clearly doesn't show legs from a quality and growth perspective. So and this is more like a crystal ball, but let me try and get to 2 scenarios which we think could be the base case for this market going forward. One could be that the market realizes that you are running at too high a speed, and let's take a breather. At that point of time, there could be a price correction. If there's a price correction, people will come back to the table and say, okay, where is the growth? Where is the sustainability of that growth? What is the valuation that I'm getting that growth at? And people will choose the more resilient one, which is where portfolios like ours are sitting. The second scenario could be that there is no price correction, but there could be a time correction and the market rotates. When the market rotates, it will again ask the same question, that from where we are rotating, where is the growth, where is the resiliency, and where is the valuation? Are they in favor? And hence, portfolio like ours would clearly be sitting there and will be up there for the market to take. So I would only say this much, that while nobody can really put a finger and say when this will end, and it could go on forever, as it is popularly said, that markets have their own mind. They can keep on running much longer than than people can get bankrupt. But at the same time, let's be honest to say that if 20 years of data, and even we can make it longer if you want, we think 20 years is good enough. But if you were to look at it and you have a probability of winning by just adopting a too simple filter of growth and quality, and you come out as a winner 63% of the times, which practically means that if you were to look at 15 years of 15 observations during this time, you will be a winner about 12 to 13 times out of that, approximately, for growth and quality, as well as either growth or quality put together. I think that's a fair ought to have. I would urge people to really look at portfolios, really see that if there are profits that have been made, it's great that these kind of phenomenal returns have come through, but there'll be a time where you may want to, take the edge a little off and relook at portfolios which are more growth and quality.
Absolutely right. I
Yeah.
completely endorse your thoughts. Yeah, Vinay.
Yeah, so I think just to take it forward from Abhishek, so we have seen, I think, almost 3.5 or 4 years now, wherein the market has, without taking a break, continued to deliver superior returns. In the same period, we had almost 9 crores new investors who have joined the capital markets, and I doubt they have seen a grain of loss in their P&L statements, and that makes me much more worried. And since you want to talk about a message to investors, the message to investors is that, remember, equities create wealth over a long period of time. We should not treat equities as tools to speculate and gamble. And mutual funds are the best route to build wealth over a long period of time. Having said that, as I said, we have launched this strategy, which we think is currently out of favor, has been an evergreen strategy, and will help investors sidestep any substantial market correction as and when that comes in.
Absolutely. Perfect. Perfect. So I think we had a wonderful interaction, understanding from Abhishek about the insights on your reasons for launching your large and mid-cap NFO. And I think they're extremely, extremely valid reasons. And certainly 50% is a number I love. What you said, Abhishek, about every client at least holding in large and mid-cap as a portfolio allocation. And rightly so, if someone's coming in with a 90% of an equity allocation for the long term and for the reason of compounding as well. Correct. And brilliant understanding, Vinay, from you in terms of your entire investment management process and the structure. So thank you very much for your time today for this video. And I wish you the very, very best for the NFO. And, I'm of course, I'm not even discussing on the performance, because while Vinay is here, I'm sure he will make sure on the performance delivery side, and I'm sure the best of the collections will happen as well. Thank you very, very much, Abhishek, for
Thank
joining.
you very
Thanks,
much.
Vinay. Thank you very much. Take care.
Thank you, Suren. Thank you.